Sarah makes $85,000 a year. That number alone puts her ahead of roughly 7 out of 10 working Americans. The median individual income in this country sits at $53,010, so Sarah isn't just doing fine, she's doing better than most people in this room ever will. And 2 Fridays from now, when her paycheck lands, she will have exactly $48 left over. Not $4,800. $48. And here's the part that should actually bother you: Sarah isn't bad with money. Sarah is good with money. Sarah is living proof that being good with money was never the thing that was going to save her. Quick and honest note before we go further. What you're about to hear is a breakdown of documented economic concepts and publicly available survey data on how American households actually spend and save. It's general education, not individualized financial advice. Your own numbers will differ by income, region, and situation, and that's exactly the point of walking through the mechanism instead of a one-size number. Let's look at Sarah's actual paycheck, because the arithmetic matters here, and it should hold up if you run it yourself. $85,000 a year, paid bi-weekly, 26 times a year, is $3,269.23, gross, every 2 weeks. On the left, that's the number on her offer letter, the number that felt like an arrival. On the right, follow what happens to it on the way to her checking account. Federal withholding, state withholding, Social Security, Medicare, her 401k contribution, her health insurance premium. By the time all of that clears, roughly $2,458 actually lands. That's already an $800 gap between the number she was hired at and the number she can spend, and we haven't touched a single bill yet. Now follow this running total as it drains, box by box, the way it actually happens in Sarah's bank account over the following 10 days. Inside the first container, rent, $1,400. The balance drops to $1,058. Underneath that, her car payment, $480. Balance drops to $578. Underneath that, car insurance, $145. Balance drops to $433. Underneath that, groceries for 2 weeks, $220. Balance drops to $213. And underneath that, the last bounded box before the next paycheck arrives, utilities, $165. The running total lands, precisely, at $48. Not an estimate. Not a worst-case scenario. That's what's left over from a salary that out-earns 7 in 10 American workers, after 5 ordinary, unremarkable line items that every single person watching this recognizes instantly. Here's the reframe this entire video is built around, and it's worth pausing and rewinding. Sarah is not broke because she's bad with money. Sarah is broke by design. Her salary is not failing to make her rich. It is succeeding, perfectly, at its actual job, keeping her exactly comfortable enough that she never seriously considers leaving, never has the cushion to take a risk, and never quite has enough surplus to notice the trap she's standing in. This mechanism has a name, and it isn't a modern discovery. It's called lifestyle inflation, and the man who first described the underlying law behind it wasn't a financial guru. He was a British naval historian named C. Northcote Parkinson. In 1955, Parkinson published the observation everyone knows: work expands to fill the time available for its completion. 5 years later, in 1960, in a book called The Law and the Prophets, that same man turned his satirist's eye toward money and coined a second law, one that has aged with almost uncomfortable precision: expenditure rises to meet income. 66 years later, that single sentence is the exact mechanism running underneath Sarah's $48, and underneath almost every raise you've ever received. Watch how this plays out over a career, because it isn't a one-time event, it's a pipeline, and it resets every single time. Let's follow David, 41, an operations manager who got a $20,000 raise 2 years ago. Phase 1, the raise lands, and for about a month, David genuinely banks the difference. Phase 2, 3 months in, David and his wife decide they can finally afford the slightly bigger apartment they'd been eyeing, rent goes up. Phase 3, 8 months in, their mortgage escalation clause kicks in on the home they'd been planning to buy, priced against the new income. Phase 4, their older kid needs braces, an expense that was always coming but suddenly feels affordable to finance rather than save for. Phase 5, the aging sedan in the driveway gets traded in for something newer, because now it feels reasonable. Track this pipeline from step 1 to step 5, at every single stage, the decision was individually rational. And at the end of the sequence, David is earning $20,000 a year more than he was, with a lifestyle that has expanded to absorb every dollar of it, and a savings rate that hasn't moved. There's a term for what happened to David, and it's worth being precise about where it actually comes from, because using it correctly is what separates a serious breakdown from a repackaged platitude. Golden handcuffs originally described something an employer builds on purpose: unvested stock grants, deferred bonuses, pension structures, deliberately engineered to make leaving the company expensive, so a valuable employee stays even when they'd rather go. David's situation is a real and useful extension of that same idea, just self-imposed instead of employer-designed. Nobody handed David a contract with a vesting schedule. He built his own set of handcuffs, one mortgage escalation and one braces payment at a time, and they lock just as tightly. Here's the concept that ties this together, and it's the single idea that separates people who build actual wealth from people who simply earn a high income. Freedom isn't a function of how much you make. It's a function of the gap between what you make and what you spend. A CEO earning $800,000 a year with a $900,000 lifestyle has less real freedom than a $50,000 earner who's banking $8,000 a year. On the left, picture the CEO's income bar, towering. On the right, picture the actual gap that income leaves behind, and in this comparison, the CEO's gap is negative. Income is the headline number everyone chases. The gap is the number that actually determines whether you could survive a bad year, walk away from a job that's crushing you, or take a real swing at something better. So let's run the test almost nobody actually runs on themselves. What happens if you had to stop earning tomorrow? Not permanently, just for 1 month. Here's the real, current, correctly separated data, because these are two different statistics that measure two different things, and merging them into one number is exactly the kind of imprecision that makes finance content easy to fact-check into the trash. According to the most recent Lending Club and PYMNTS Paycheck-to-Paycheck research, released in 2026, roughly 62% of American consumers are living paycheck to paycheck right now, and that figure isn't confined to lower earners. 44% of people earning over $100,000 a year report having little to no money left over after their expenses clear. That's a completely separate statistic from the second one, so read this number carefully too. A 2026 survey from U.S. News & World Report found that roughly 1 in 3 Americans, 33%, do not have enough savings on hand to cover even one single month of living expenses if their income stopped today. 43% said they couldn't cover an unplanned $1,000 expense without going into debt for it. Those are two different findings, from two different studies, and they're more credible standing separately than they would be blended into one inflated headline number, because both of them hold up if you go look them up yourself. Here's what should land differently now that you've watched Sarah's paycheck drain box by box. 62% living paycheck to paycheck was always going to include people earning $35,000 or $40,000 a year. It is not supposed to include someone out earning 7 in 10 American workers. But it does, because the mechanism isn't about income level. It's about the gap, and Parkinson's second law doesn't check your salary before it goes to work on your spending. Now here's where this video turns, because the fix is not what most of this content tells you it is. The fix is not motivation. It is not willpower. It is not another version of "stop buying lattes" dressed up in new packaging, and if that's what you expected walking in, this is the moment that gets rewritten. Deprivation was never the mechanism that trapped Sarah or David, so deprivation was never going to be the mechanism that gets them out. The actual unlock is awareness of the sequence, because the sequence is the entire game. Here is the 3-part fix, in the order it actually has to happen, because doing these steps out of order is exactly how well-intentioned people end up right back at $48. Part 1. Separate income from wealth, permanently, as two different ideas in your head. Income is what lands in the account. Wealth is what's left after the account empties out for the month. Sarah has strong income and zero wealth. Confusing the two is the very first domino, and every domino after it falls because of that one. Part 2. Attack the gap before the next lifestyle upgrade arrives, not after. David's mistake wasn't any single decision: the bigger apartment, the mortgage, the braces, the car, every one of those was defensible in isolation. His mistake was sequencing. He let his spending catch up to his raise before he decided, in advance, what portion of that raise was untouchable. The fix isn't refusing the apartment or the braces. It's deciding the split the day the raise lands, before the money has a chance to quietly disappear the way Parkinsons said it always will. Part 3. Redirect the gap into assets before it has the opportunity to become a new fixed cost. A savings account, a retirement contribution increase, an index fund, the mechanism matters less than the timing. Every dollar that gets automatically redirected on day one, before it ever touches a checking account that also pays rent, is a dollar that Parkinson's second law never gets a chance to absorb. This is where optionality actually comes from, and it has a real, source standard behind it, not just a talking point. According to Bankrate's most recent emergency savings research, 85% of Americans say they'd need at least 3 months of expenses saved to feel genuinely comfortable, but only 46% actually have that much. 63% say they'd need 6 months to feel secure, and only 27% have reached that number. That gap between what people say they need and what they actually hold is the same gap running through Sarah's paycheck and David's raise. The awareness is there. The redirection isn't. 3 to 6 months of expenses, held outside your checking account, in something you're not tempted to spend, isn't a magic number pulled from nowhere. It's the buffer that turns a job loss from a 5-alarm emergency into an inconvenience you can actually think your way through. Let's go back to Sarah's paycheck one more time, with the full picture in view. $85,000 a year. $3,269.23, gross, every 2 weeks. $2,458 after taxes and deductions. $48 left after 5 ordinary bills that would look completely unremarkable on anyone's bank statement. None of that happened because Sarah made a bad decision. It happened because a decades-old law about human financial behavior has been running in the background of her life, undetected, since the first day her salary went up. Understanding why your raise didn't fix anything is the first fix. It is not the whole fix. There's a second mechanism sitting quietly on top of this one, the reason two people with the exact same income and the exact same discipline can end up with completely different financial outcomes by their 40s, and it has almost nothing to do with how much either of them earned along the way. That's exactly where we're going next.